Hi and good morning, everyone, and welcome to our webinar 2026, A Moment of Truth for the Global Economy. So I'm Mona Johansen, and I'm the Marketing and Communication Manager here at Coface Nordics. And I'm joined today by our economist, Jonathan Steenberg. We were also supposed to see our CEO, Pekka Puutunen, today, but unfortunately, he had to tend to an urgent matter, and he sends his apologies. Before we dive in, just a couple of practical things. So this webinar will run for approximately 60 minutes. After Jonathan's presentation, we will have a Q&A session. And you can send your questions throughout the webinar. Just click on that little question mark and send your question, and we will answer them at the end. And with everything going on in the world today, we're hoping for a lot of questions. So the session is recorded, and both the slides and recording will be shared with you afterwards. So when we invited you, we said, while the headlines are gloomy, the actual number paints a more nuanced story. And then we had a new war. So Jonathan, can we still stand by our message? The floor is yours.
Thank you. Yes, I think we can, to a certain degree, stand by it. At the very least, when we made the message, I think it was the correct thing. Yeah, obviously, a lot has happened in the last month between us sending out the invite for this webinar and now it happening. Not just an election being announced in Denmark, so to all the Danish people joining, well, have a good election day. Hopefully you'll get some valgflæsk. I at least think during the campaign it sounds like there's been a bit of it. But obviously also the war in Iran, which has been the key thing that has, I think, made headlines, but also been the key worry for us in Coface in the last few weeks. Just to set the scene of where we were when we made the latest changes to our country and sector risk assessments. I'll sort of paint that picture first, and then I'll focus more in on what we are seeing with the war in Iran and the economic consequences thereof, how that affects the global economy, and then lastly, how it affects the Nordics. So where were we in the beginning of this year? Well, generally speaking, one of the things that we highlighted was that while the headlines were gloomy for the time being, actually the economics were all right. Q4, generally speaking, came in pretty well in most parts of the world. The end of last year was seemingly a pretty good one. We can also see that after some a tumultuous period in the middle of last year around Independence Day and uncertainty around tariff levels, generally speaking, sentiment started to improve as well. That was true both on the service sectors, which have generally been doing better in the last few years, but even around manufacturing, there actually also was some positive things. And this was really the 2026, to a large degree, was seen as one with risks, but with a stable macroeconomic backdrop. Inflation was to ease in many parts of the world. We still expected policy rates to come down, including in the US, and in several, especially advanced economies, including in the Nordics, real wages were to increase, and people have been saving up money, which means that in a more stable environment, they would finally start spending them. So again, the backdrop was pretty benign. But what we did highlight in the beginning of the year was that there were many risks that could challenge this backdrop. And obviously, one of them, at the very least, materialized. And I'll get to that in a second. Before we do get to that, I just wanted to highlight what were the changes we actually did make in the beginning of the year. And again, with this backdrop that I just described, a slightly more positive one than you'll probably hear me say today, we did quite a bit more upgrades than we did downgrades. We did 6 upgrades and 1 downgrade. The downgrade was in Senegal. It's a pretty idiosyncratic one. There has been some issues with the public finances in the country, which have led to both some political and financial issues in the country. There was seemingly a lot of hidden debt that was found. So it's not just commodities that you can find hidden, it can also be sometimes debt. And that has created quite a bit of turmoil in the country. For the upgrades, a lot of them were in South America and Latin America, Barbados, Ecuador, and Chile. A combination of going back to their previous levels. Barbados was still seeing improvement in tourism and some investment. Ecuador has seen an easing of some of the political turmoil that has been there, as well as getting an IMF loan. And Chile was similar, recovering a bit from a period of political turmoil and economic slowdown. So generally speaking, a positive story. Closer to home, we upgraded Cyprus. Again, tourism, higher investment, EU funds. Poland, somewhat of a similar story here, after being really hit by quite high inflation and negative consumers. Inflation was easing, manufacturing was actually starting to improve a bit, and there were a lot of investment, particularly from EU funds, that was still eligible in 2026. So that should have been a key driver of the economy, and we still believe will still be a key supporter of the economy. And lastly, closer to home, about as close as you can get, we also upgraded Sweden back to an A2 after being in A3 for around 2.5 years. This was due to, after a longer period of weak economic performance, very high unemployment, very high interest rate, quite high insolvencies as well. We started to see some improvements in the latter half of last year, and generally speaking, the first few months of this year still showed a relatively benign environment, and that's why we felt comfortable upgrading it to an A2 back again. Again, just to remind us that Finland and Iceland are still A3, and Denmark and Norway are still A1. And again, most larger economies in Europe, France, Germany, and the UK remain in an A3. So what has then been the key driver, the key change since we did this upgrade? Now it is the de facto closure of the Strait of Hormuz. While I'm sure many of you have heard a lot about this in the last few weeks, I just wanted to start here by reminding everyone of why it is important. It's a key choke point for global trade and energy. It travels around a fifth of global oil, and it is, again, more or less closed. As you can see on the left-hand side, there are close to no vessels going through. If they are, they're usually Iranian vessels that are sailing through. But it's not just oil and gas, and that's an important thing to highlight. While these are the ones that make the biggest headlines and will have a very clear impact on the global economy, the region is also key exporters of other commodities, including fertilizers and petrochemicals, methanol, as well as several other key components in the global supply chains. And this will both have direct impacts. If you are an importer of fertilizer from the Middle East, obviously there will be an impact from this. But also, if, let's for example say that you import some agri-food from India and they import it from the Middle East, there will be a second order impact here that could start affecting you even if you aren't directly exposed to this. There's also, and this will be true across all of these commodities, the indirect price impact, because most of these are traded globally, which means that even if you are not a direct importer of it, these are usually global markets, which means you will feel the increase in prices. But again, the reason why I highlighted India just before is that emerging Asia is where we are expecting to see the biggest impact. As you can see here on the left-hand side, India, China, Japan, South Korea, and other Asia are the main importers of crude oil coming through the Strait of Hormuz. Some of it goes to Europe, it's a smaller fraction, some to the US, a few others to other destinations. But as you can see, emerging Asia is very much the key target here. For LNG, it's a similar story. China, India, Taiwan, South Korea, Pakistan, other Asia makes up by far the largest share. Europe is slightly more exposed to this, but again, it is very much the Asian countries that are usually the main importers of this. What you need to keep in mind is also that these are usually countries that operate with a lot lower stock than we're used to in Europe. In Europe, we're usually pretty good at keeping a relatively good amount of stock of oil, LNG, all kinds of commodities. And during these kind of crises, and very much saw this in 2022, what we see is intense competitions around the commodities that are going about. What usually happens is the prices increase as we in the West or in advanced economies, richer countries, buy up the remaining stock, which means the emerging countries, the poorer ones, usually either can't afford it or suffer with actual shortages. So the impact of this kind of crisis hits the two types of countries very differently. Where we are in the world, the main impact will be higher prices. If you're looking somewhere like emerging Asia, we might see actual shortages of some of these key commodities. I've here called the reaction so far on the oil market only somewhat dramatic so far. And again, if you look in nominal figures, we have seen quite an uptick in oil prices. There's a lot of volatility. However, if you look in real terms, so if we deflate it, this is still a relatively limited crisis compared to the potential impact that it could have. Essentially, if we saw a continued conflict, the current increase in oil prices is not sufficient. The market is still pricing in that this will be a short-lived conflict. And again, it's important here to highlight some of the key differences between the last crisis, the 2022 one, and this one. In 2022, much of the focus was around LNG. That is what usually will impact stuff like our heating, our electricity. Whereas this point, oil is far more of a worry. That will again hit transport in particular, but anything really that runs on oil will see a far bigger impact this time around compared to the last crisis in 2022. So, are there any clear alternatives to get around the Strait of Hormuz? The answer is essentially no. Around short of 20 million barrels usually go through the Strait of Hormuz. You can see that's the blue bar on the left-hand side. There are some rerouting capacity. This is mainly Saudi Arabia being able to move it through their pipeline from the east coast to the west coast. There is limited capacity here. Just to highlight that for the time being, they're operating around 2.5 to 3 million. They believe they can push this up to around 5 million barrels. There is also some alternative from the UAE that can go around the Strait of Hormuz. It should be mentioned that some of these areas have been attacked by drones so far, but there is still a way to move around it, even there is still some risk associated. And there are, again, some Iranian exports still coming out, which means there is some oil and gas coming out from the Middle East. But again, we are looking at the very least around a 12 million barrel shortage, again, with about 4 additional million still in question. So some is coming out, but a lot is not. And some of these countries do not have any alternatives and are currently being forced to shut down their oil production because their domestic storage is already filled up. And once you shut down production, it takes a while to build it back up. On the positive side, we did see some stock build up in the last few years. As you can see on the right-hand side, oil and oil products, in generally speaking, we are looking at a pretty good inventory and stock level. On total, we're around 60 days. In Europe, we're close to 70 days, which is again a pretty good level and can keep us going for a long time. However, it's not exactly the same across all types of energy commodities. The middle distillates are more sensitive to this. These are things like diesel, but they're also things like jet fuels, which is why we have seen a lot more noise and volatility around the prices of these. There is quite simply less stock out there. I think SAS is a clear example of companies struggling with potential shortages, at the very least some issues around prices, potentially due to insufficient hedging risk, but there can potentially be some actual shortages here if we are looking at a prolonged crisis. This is a chart that a few years ago I was showing twice weekly, if not more. And I was hoping I wouldn't have to show it. It basically shows the natural gas inventories in the EU. Generally speaking, we had learned our lesson. After the 2022 invasion in Ukraine and the subsequent energy crisis, we learned that it was a pretty good idea to have a good storage of natural gas when we came into the winter. And for the next few years, we did. As you can see, in 2024, we were around 90% when we started the year. When we started the year. In 2025, it was slightly less, but we were still around 75%. That is around the 10-year average. It's again pretty good. This was the year where we forgot that lesson. We were closer to the bottom of what we'd say is a usual cycle. This is not just that we have the memory of goldfish. It's also the fact that we did have a bit of a colder winter than we've had in a few years. Given this, we are now more susceptible to a longer crisis, given that we are at a lower stock level, but also if we were to see cold temperatures come back in the next few months. If we saw a combination of a prolonged crisis and again colder temperatures again, we would probably see energy prices pick up quite a bit. It is again important to highlight that there are key differences between what we saw back in 2022, as you can see on the right hand side, and what we're seeing now. While this is a serious uptick, we are not at the same level as we were back then. Again, the current issue is more around oil than it is around LNG. Another thing to highlight is the difference between the US, Asia, and Europe. The US mainly operates with its own gas, the Henry Hub. It's more focused around pipelines and less vulnerable to LNG. That means if you're an energy intensive producer, your American competitors are working in a far more benign environment than you are at the moment. So what does this mean for inflation and interest rates? Well, if we focus on the US to begin with, we were generally seeing relatively stable inflation, slightly above the 2% target, but it used to stay around the 3% with some easing, particularly around service inflation. There was a bit of an uptick around core goods, in parts thanks to the higher tariffs. We saw this increase. That's the gray one you see on the left-hand side. But because of a weakening labor market, we saw service inflation come down, which means that overall inflation remained relatively subdued. And on a positive note, energy inflation remained around zero. In Europe, it's a similar story. We were around the 2% target. Goods inflation, unlike in the US, remained relatively low, in parts thanks to China. We can get to that one in a second. But on a worrying level, service inflation remained slightly more sticky. And energy inflation was actually negative in the latter half of 2025 and the early months of this year. Obviously, the current energy shock will challenge this. Even if the conflict ends within the next few weeks, this will have an impact on energy prices for the rest of the year. We are now expecting that to increase towards the latter half of the year. This will be more pronounced in Europe than it will in the US, but it will also have an impact on the US. So after seeing a period of easing inflation, we do expect it to start picking up again. This will initially mainly be focused around energy. And then a big question will be, how long will it be? What will the government intervention be? And will it start feeding into other sectors and people's inflation expectations? Because for the time being, we are still believing this is a transitory uptick in inflation. However, as we learned back in 21-22, transitory increases can become less transitory if they are prolonged. So on a policy rate level, and again also in longer fixed interest rates, we are now seeing a bit of a shift compared to what we saw a month ago. A month ago, we were expecting to see the Federal Reserve cut rates throughout the year, around 2 to 3, depending on some inflationary pressures and what happened around tariffs. We expect the Bank of England to follow. We expect the ECB to, generally speaking, remain around their current level, which is close to what we believe is their terminal rate. And we believe the Bank of Japan either were done with their hiking or potentially had one more hike in them. That has been postponed for the time being. Any potential cuts are on hold. And for the time being, we still believe the ECB will be able to hold and not hike, but a prolonged crisis or further attacks on energy infrastructure can challenge this outlook. If we were to see a conflict end within the next few weeks, we could still potentially see a interest rate cut in the latter half or Q4 in the US, and we could potentially see a scenario in which the ECB are able to just hold at 2%. But if the conflict is prolonged, then there is a chance that we could either see zero cut from the Federal Reserve, or if it really starts feeding into high inflation, a potential reversal of this. And the same could be true at the ECB as well. The big question here will be, will the impact be bigger on activity or will it be bigger on prices? And here there are many questions, which will include how much government spend up to support the labor market and demand, similar to what they did after COVID and during the energy crisis. I know they have. Sweden have announced that they're going to do some energy support measures. It's almost like they have an election this year coming up. On the longer interest rate level, we do expect to be a continued increase in sovereign interest rates, which will again also feed into corporate bonds on the 5 to 10 year period in particular. Generally speaking, this is feeding into slightly higher inflation expectations, especially on the short end. But again, given the fact that we would expect there to be some government support, we also are looking at potentially further borrowing from governments in a period in which they have already borrowed quite a bit without most likely increases in tax revenue to match it. And because of that, the underlying risk premium on sovereign bonds is expected to increase as well. Before focusing in more on the Nordics, I wanted to sort of take some of the key big regions in the world and just say, do a sanity check. Where are we? Because the US is one we spoke about a lot last year. The impact of tariffs, the slowdown in the economy, there's still resilience of it in parts thanks to AI infrastructure and investments. So to give the headline here, the US is holding up for now. As you can see on the left-hand side, the core GDP, where we remove all the volatility around imports, exports, especially in the beginning of last year during the fears around Liberation Day and tariffs, we're looking at a slowing but still relatively strong economy, growing around 2 to 2.5% a year. It's still pretty benign. If we look at the labor market, it is clearly slowing as well, but again at a level that is still acceptable. And it should be highlighted the fact that 2023 and 2024 were extremely strong years for the US economy, which means no matter what, we were expecting a slowdown in 2025. So again, the headline figures is holding up in the US. But there are several underlying risks here, kind of similar to the story we told about the global economy. We are still seeing the impact of tariffs gradually feeding into the economy. As you can see on the right-hand side, tariffs observed have picked up quite significantly, eased slightly in the last bit of the year, but it's still about 4 times higher than it was before they started being enacted. And this is very much feeding into higher producer prices domestically and higher consumer prices. About 80% of increases in tariffs is passed on domestically. Only 20% is passed on to the exporters, and this is usually centered around certain sectors. And for the time being, it seems like most companies are seeing squeezes to their margins as they are either choosing or are unable to pass on the cost to consumers. And again, 1/3 is feeding into higher consumer prices. This will obviously have an impact on companies, particularly the smaller ones, as we saw in the last quarter of last year, but also in the beginning of this year. A second key risk is this K-shaped economy. It's something you may or may not have heard spoken about in whatever financial news you read, but it's this thesis that was really keeping up the US economy. It's this richer individuals. So while the labor market, while labor income has decreased or slowed down, consumption is really being carried by these richer individuals who are mainly able to consume due to their savings and investments. But this is obviously then very, very reliant on the state of the stock market, given that the US consumers are far more exposed over to stocks as opposed to bonds or other fixed rate products. So if we saw a slowdown in the stock market, if we saw an easing or potentially adverse reaction to the quite strong performance around certain bonds, we would start to see the impact not just on the labor income point of view, but also on the savings and investments part of it, which means again this K-shaped economy story, which was that the top half was able to carry the overall economy, well, that will be questioned as well. A last risk, in addition to the energy risk that sort of is hitting almost every sector, is this vulnerability around the private credit market. This is again something I think we've all heard about, and it's something that has become even more pronounced given higher energy costs and probably a higher interest rate environment for the foreseeable future. There are several of these companies within this space that are very vulnerable to the interest curve. And if we see higher rates, both on the short and long term, that will adversely impact these companies. So again, I think the headline around the US is, for the time being, it is still holding up, but there are a lot of risks to this. And a prolonged crisis will really challenge this and could have a clear negative impact on the economy as well, even if the US is less exposed than emerging Asia or Europe. I won't go into too much detail around China. I've already spoken a bit about emerging Asia. But one thing to keep clear around China is the fact that we are still looking at this supply-demand imbalance. We still want to highlight the fact that there is an oversupply of several things. There is excess capacity, not just in the electrical vehicle market, which is the one I'm showing on the right-hand side here, but among several products and commodities. Increases in energy prices could potentially help here, given the fact that will constrain supply slightly, but obviously that would cause other issues. The fact that we are seeing these constraints explains to a large degree why the CCP, the Chinese Communist Party, have agreed to lower their growth target from 5% to now 4.5% to 5%. Some would argue that it has not been around 5% for a few years. But we do not expect the domestic demand to live up to the supply capacity. And given the fact that tariffs are still high from the US on Chinese goods in particular, we are still worried whether or not a lot of these goods will be moved towards other destinations, including Europe. And this feeds in quite nicely to what continues to be our main issue in Europe, and it is our manufacturing sector. It is suffering with a genuine issue of competitiveness. It's an Achilles heel, and it has continued to be so since the energy crisis in 2022. As you can see on the right-hand side here, from 2020 to 2022, we saw a big uptick, both in actual production, so in volume terms, but also in turnover. We saw a big uptick, to a large degree driven by prices, but as you can see, also driven by increasing volumes. But since the energy crisis, we saw production go down and even turnover decrease as well. Production essentially hasn't grown for around 6 years now. And turnover has been coming down, particularly in certain sectors. And that is something we want to highlight. Again, if you look on the top left corner, it is certain countries that are more exposed. In volume terms, Germany, Netherlands, Belgium, as well as Italy has seen quite a downturn in their manufacturing capacity in volume terms, as well as to a large degree in turnover terms. However, if we focus in on sectors in Europe, we see a big divergence here. In certain sectors, such as, for example, the agri-food sector, it's still doing relatively okay. While there has been an increase in costs, most of this is able to be passed on to higher prices and higher turnover. We are seeing it's both above its 2022 levels, and it rose last year as well. Electronics is a bit more of a diverging sector, and machinery is the same. But again, you still see some stability here, as well as an improvement in 2025 versus the year before. Where we continue to see the biggest issues is anything energy intensive. Since the energy crisis in 2022, we simply can't compete there. Textiles is down and still falling. Metals is down, still falling. And chemicals is the key example of this. One of the key components in chemical production is usually straight LNG into it. It's about 70% of the cost for many of these products, which means if gas prices are up, you're not competitive. And you can see since 2022, chemical turnover is down by almost 25%. And it continued to fall last year as well, which means that it continues to be the case that if you are an energy intensive manufacturing company in Europe, you are having a difficult time. The current uptake in LNG prices is not helping here. This is particularly true in Central and Western Europe. There are some examples of regions that are doing slightly better in Europe. Spain is one of them. They are far more reliant on renewable energies, which has helped them quite a bit, as well as the northern part of the Nordics. Again, if you have a manufacturing base in northern Norway, northern Sweden, you are still looking at relatively nice electricity prices. So there can be some winners here as well, but if you are mainly a subcontractor to a German chemical company, you will continue to see your key buyer struggle. And we don't expect that to improve this year, particularly if the crisis continues as it's currently going. So this is our central scenario for now. It is still a slowdown in the global economy, just a small one for the time being. The US, we expect to hold up growth, again, very much helped by certain sectors. Across Europe, we expect growth around 1%. We expect this slowdown in China that I've already mentioned. And we expect the Indian economy, as an example here of some Southeast Asian countries as well, to still be strong, but maybe slightly slower than we saw in 2025. In the Nordics, and we might have to reverse this downwards slightly, we did expect still relatively good growth in Denmark and Sweden in particular, and relatively stable growth in Finland and Norway. It should be highlighted here that in Finland in particular, this is coming after, as you can see, several years of very, very low growth. So while this is obviously a positive story, the base effect here is helping it a lot. That is coming from a low level. It's quite a lot easier to overshoot it. And we would still highlight that Finland stands out in the Nordics as one of the weaker economies here. From a global corporate insolvency level, we are still looking at very, very high levels. As you can see, insolvencies are on a global level at the highest level since 2013. They were still increasing in 2025 around 5%. This was in particular driven by the US, which saw a bit of an uptick, Asia Pacific, and Europe as well, albeit that we did see a slowdown in increases in Europe. They were still increasing, but a lot less than it has in the last few years, in which we essentially saw double-digit growth in insolvencies for a few years straight. Our forecast in the beginning of the year was that insolvencies would rise about 3% globally. That is probably too optimistic. We did highlight an alternative scenario in which we just focused on higher interest rates, about 25% higher basis points, which is not off what we're seeing right now, would easily bring global insolvency growth back until 5 to 6%. And that is not taking account slowdowns or shocks to key inputs, such as, for example, energy, but also fertilizers, etc. So I think we can be honest in saying that the plus 3% is probably an optimistic forecast at this point. So what are the key takeaways? Again, I showed you our main scenario for the time being. And where we stand is, generally speaking, the Strait of Hormuz is blocked. As I said, we've seen increases in several commodities, not just energy, but also across the board. There has been some emergency releases of oil by EEA members, actually higher than we've seen for a long time. And we have seen some reactions on financial markets as well, particularly in Asia and Europe, but we've also seen some in the US, but they are somewhat being masked by some IT and communication companies doing a lot better. So consensus seems still to be, in at least financial markets and some commodity markets, that this will be a shorter-lived conflict, that we hope for a resolution within the next few weeks. This will, generally speaking, mean that we will have some volatile months, but for the full year, the impact should still be limited. But that being said, there could still be some revisions, especially around the middle of this year, due to it, even if the conflict ends within the next few weeks. What really concerns us, and we have seen some of this materialize to a certain degree as well, is further damage to energy facilities. That is oil facilities, LNG facilities, whether that is production or refineries. It could be sea mines in the Strait of Hormuz, as has been threatened repeatedly. This would challenge not just short-term transition risk, but also medium-term production risk. We've already seen some key producers of oil and gas say that it will take weeks, months, in some cases years, to rebuild capacity up to where it was before the war. And something to highlight is, again, that natural gas inventories were weak in Europe, and they're very weak in certain parts of Asia. This will most likely lead to supply chain disruptions. I'll get to that in a second in more detail. And we could also see social unrest increasing. Again, as I said, in these kind of crises, in advanced economies, in richer countries, we usually see this materialize into high inflation. In poorer countries, in emerging economies, this can lead to actual shortages of energy and of food. And that is obviously a completely other kind of crisis, in addition to the economic one. An alternative scenario that we also have built up, in which we see energy prices sort of neutralize a bit, but basically stabilize around 50% higher than we were expecting beforehand. We'd expect that to take off about half a percentage point of global growth. Asia would again be most severely impacted. We'd see quite a slowdown in Europe as well, down to around 0.5% of growth. US would take a knock as well, but again, compared to other regions, less so. Would expect global inflation to pick up, particularly in the latter half of the year, and this would impact monetary policies, especially in emerging economies, who usually always have to react bigger in order to not see capital outflow. This will have a clear impact on monetary balances and could potentially lead to some debt distress in certain countries. This would essentially impact all sectors. Some are more vulnerable, and I'll show you some of those later. But generally, this would impact everywhere, and we'd expect insolvencies to start picking up again, re-accelerate, especially in Asia. So in the Nordics, again, while I will say that we've generally speaking seen a relatively stable level of economic activity compared to several other parts in the world, one thing to keep in mind is actually the fact that a lot of this is very much helped by public spending. On the left-hand side, you see the private domestic demand. This is this that I earlier called core GDP for the US. So that is private consumption and investment. while this is still significantly above its 2019 levels in everywhere except Finland, and that's obviously a very positive story. So some countries haven't grown since 2019. That is not the case in Denmark, Norway, and Sweden. However, since 2022, since the energy crisis, as you can see, private activity has actually somewhat stagnated. There was a clear reaction afterwards in which people slowed down their consumption and investment. That has been improving, but generally speaking, it's just now coming back above that level. If we saw another energy crisis, this could obviously impact it again. So where a lot of the growth has been is in certain exports. I was about to say each country has certain exports that's doing very well, and it's usually been doing quite well in the last few years, but also very much from public demand. As you can see, since 2022, most of these are around 5 to 10% higher than they were before the pandemic. And as you can see, particularly in the last few quarters, we have seen quite generous increases. Somehow it seems especially high in countries that have elections this year. I can't explain why that's the case. One of the key worries would be around consumer sentiment and the state of the labor market. Generally speaking, and again, I said that in the beginning, one of the key positive drivers, sort of the macro backdrop that should keep driving this year, was the fact that interest rates were lower than they have been, and real wages have been picking up and people have been saving up. Again, on the left-hand side here, you see the fact that real wage growth continues to be relatively good in most countries. It is between 1 to 2.5%, and people have been saving up. Unemployment is generally, compared to a historic level, relatively low in both Norway and Denmark. And while it's still high in Sweden, it has been easing somewhat compared to its peak last year. In Finland, it is still worryingly high. It has seemingly come down somewhat from its very much peak, but I think it's too early to say anything there yet, especially given the current economic environment. Again, as I've highlighted several times, Finland does slightly stand out from the rest of the Nordics here. What has not really, what we haven't really seen yet is an improvement in consumer sentiment. Despite the fact that real wages have now been increasing for 2 years straight, despite the fact that generally speaking, unemployment has been going the right way, consumer sentiment is still quite negative. And again, an energy shock, uncertainty around the world, war, usually negatively impact this. And that means if we see continued issues of basically people are technically richer, but they just save it all up and don't consume it, that will have a negative impact on the domestic activity in the Nordics. And that continues to be a key worry that we have. Will this ruin the somewhat positive momentum we've seen, in which consumers seemingly are slowly getting ready to use a bit more of their money? Again, inflation has mainly been under control in much of the Nordics. The one exception here has been Norway, in which particularly service inflation has been quite sticky. It is also true across the board that if you remove housing from services, service inflation is still relatively high across the board. This obviously then means that if we saw an increase in policy rates, that would now then start contributing positively once again. Again, because of the base levels, because of how low it is, we don't see any immediate issues here. We do expect the Danish central bank to follow the ECB, which again means our main scenario is that for the rest of the year it will hold. Riksbanken made it very clear as well that for the time being they expect the policy rate to stay where it is. In Norway, where we did expect a cut, I think for the time being we will probably see them hold as well, which means that Norway again continues to stand out as with quite high interest rates compared to many of its peers. So before I end here, I just wanted to highlight the fact that I said earlier that almost all sectors will be impacted by the current crisis, even if it's a short-lived one. Again, I've highlighted here some different things: energy prices, higher interest rates, less purchasing power, worse sentiment, direct shortages, fertilizers, methanol, but also indirect ones, plastic, electronics, textiles, especially if they're coming from emerging Asia, as well as a disruption in shipping and cargo. As you can see, and I've only highlighted some of them here, this will indirectly impact almost every single sector. But where we are more worried for the time being is some of the ones I've already highlighted. Energy intensive industry in Europe is struggling. This will only impact it more adversely. Chemicals, metals, textiles. Agri-food will probably see a shock from this too. We are slightly helped in Europe in the fact that due to CBAM happening as it did, there was an initial import of fertilizers into the European Union, which means we have a bit more stock than we usually would have. That can help us, again, if this is a short-lived conflict. But again, we would still expect there to be some impact here. Some upstream energy could be impacted here. Again, not the producers, that probably do fine, but further on the value chain, there can be some people squeezed, as well as, again, transport, especially air cargo, has been severely impacted by this due to how much of air travel goes through the Middle East. So while we do expect this impact to hurt every single sector, there are some that we are more worried about, and also on an immediate level, we are slightly more worried about. Lastly, just to highlight where we are on insolvencies, not just on the global level, but particularly in the Nordics. As you can see, we started this year at a pretty good level. Looking at the last 3 months, that would be for all of them December to February this year. We are down in Denmark, Norway, and even Sweden coming down as well after easing in the latter half of last year as well. Finland continues to stand out here as seeing continuous increases in insolvencies. Again, there are some differences in regards to which sectors we're currently seeing insolvencies rise in. Agri-food is increasing in Denmark and Finland, but less so in the other ones. Energy has seen some vulnerabilities as well, and we have seen a bit of an increase again in construction in Denmark, in particular in Finland. But some of the key ones we want to highlight is one I've already said: metals increasing across the board, textiles, clothing increasing across the board. Again, also real estate, so not the actual construction companies, but the real estate companies also continue to mainly see increases in insolvencies. So while there are still a somewhat stable economy in the Nordics, certain sectors are definitely still vulnerable and are feeling the brunt of the current economic environment, and will probably see a deterioration in the next few months, especially if the conflict is prolonged. I think I'll end on this. If we have any questions, I would love to answer them.
Well, thank you so much, Jonathan. Let's start the Q&A, and we have already a couple of questions here. So I'll start with the first one, which is, what would be the key worries for companies in the Nordics?
I think companies in the Nordics, it really depends on where you're based. It depends on the sector. This is going to be the very boring answer, but again, if you are a manufacturer not based in northern Norway or northern Sweden, this will impact your bottom line. The big question will be, are you able to pass on these costs? What is your key buyers? Where are they based? Are you mainly exporting to, again, Germany, Italy, etc.? There will be some vulnerabilities down there. I think a second thing is understanding your suppliers. We already know that we have some clients who have seen issues with either companies in the Middle East, either unable to produce at the moment because of energy shortages, or unable to get their goods or export their goods. So there can be both, can I produce it, but also can I get it out? Has been an issue. So these are more the direct ones, but we are also seeing shutdowns in some sectors in South Asia and Southeast Asia. And these will obviously, if you are importing from here, that can be a key issue. So I think the direct impact can also affect them, but I think it's more the indirect ones, either your buyers, especially if they're based in Central Europe, or your suppliers if they're coming from Asia. I think will be the key issues right now, and we are also seeing some of that.
Yeah, thank you for that, Jonathan. And I have the next one here. What do you expect for Africa?
Yeah, so Africa's is usually always hit in a very particular way, which is that it is very sensitive when it comes to energy and particular food. So it can also be and some economic consequences here, depending on the country. Again, if you are a net importer of energy, which most African countries are, this will have a very negative impact. If you are next exporter, so we have some Angola as an example here, there would be some positive consequences. What we sadly usually see in these situations is increases in fertilizers and food impact these countries disproportionately. We see big increases in domestic inflation as food prices pick up, and there can be some cases of potential famine and social unrest. If we see a prolonged conflict, that could definitely be an issue we could see here. There will also be some of the aforementioned problems of shortages in regards to industry, etc. I think what makes Africa slightly more unique here is I think we'd probably see more shortages and potential social issues there. And on top of that, we also have some countries that are suffering for quite high sovereign debt, which means if we see this reversal of increases, then that could also potentially see some sovereign debt defaults in the continent as well.
Okay, thank you. Then we're moving over to the next one, which are we seeing any actual impact beyond energy prices?
Yeah, so again, energy is the big one. I already mentioned that we are now also seeing both impact on supplies. Some companies have a difficult time getting whether it's the fertilizers, whether it's some petrochemicals, whether it's some metals. We're also seeing some issues around, for example, aluminium as a key one. These shortages are already affecting companies now. And there has also been some disruption again, in particularly if you are trading directly with the Middle East in getting goods in and out of there. And that's obviously something that we're working with everyone, really trying to resolve how that is resolved and how that hopefully does not end up in a claim. So yeah, that's definitely a tangible impact so far.
Okay, well, thank you for that, Jonathan. We don't have any more questions at the time being. Yeah, but here we got one. So, it says, thank you, Jonathan, for an informative webinar. Is the link valid for some time to me to look into it again? Yes, we will send you the recording of the webinar. I will answer that for you, Jonathan. So you will have the recording and you will have the slides. So with no further questions, I think we will wrap it up here. Thank you so much again, Jonathan, for your presentation. And thank you for everybody joining us today. And if you want more economic news from Coface, you can just go in and follow us on LinkedIn. So have a nice day and see you next time.
Thank you very much, everyone. And hopefully next time we do this, there won't be a war. Thank you.
Hopefully. Okay. Thank you and see you.